Hi, you guys. Welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. As many of you know, I am a REIT investor. I don't have the money to invest in personal properties, so I invest in real estate property through REITs. And for those of you who don't know what REITs are real estate investment trusts. It's basically a way that the general public can spend small amounts, buy shares of either a REIT or an ETF that does REITs, and they can conversely have a little bit of real estate exposure in their portfolio. So this is an article from seekingalpha.com. Now it's back from October 19th of last year, but I think it still holds true. It says, very bad news for REIT investors. What could derail the REIT train? Real estate investment trusts are a phenomenal way for the average investor to participate in the asset class of commercial real estate that has historically been reserved for private investment companies and high net worth individuals, i.e. the people that have money to invest in properties, right, up front. American REITs, VNQ, which is the Vanguard Real Estate ETF, now own approximately $2.5 trillion worth of real estate and have a combined market cap of about $1.6 trillion, implying that the sector as a whole is only capitalized by about 36% debt. REITs have also enjoyed fantastic returns over long time periods. According to NAREIT, that's the National REIT Association that keeps an eye on this stuff, from 1972 to 2021, equity REITs outperformed all three major stock indices, the S&P 500, the NASDAQ Composite, and the Dow Jones. And if we take a look here, you guys, at this screen, we see that, for example, in 2021 year to date, the S&P 500 has done 21.58. There are definitely years that one has outdone the other, but if we look at the whole, all equity REITs overall have done 11.86 compared to 11.1, 9.15, or 7.69. Now, obviously, these numbers change from time to time, and we know that. But let's talk about... But as explained, REITs perform better in some environments than others. The worst economic environment for REITs is one in which economic growth rates are slowing down and interest rates are going up. That sounds like what we have going on right now, doesn't it? But it appears as though we might be headed for just such an environment, as inflation is speeding up and the Federal Reserve's rate hiking plans, even while projections for future economic growth are dropping. This would be very bad news for a lot of REITs if that was true. So let's take a pulse check on today's economy and try to assess whether and how much REITs are threatened. One threat is the threat of inflation and rising interest rates. Since the trough of COVID-related sell-off in March of 2020, REITs have surged around 80%, reaching a new all-time high as an index. And those of us who have VNQ, the real estate index, have benefited from it, you guys. But are these high prices threatened by inflation and the probability of rising interest rates in the near future? After all, though the rent rates of hot property sectors like multifamily and industrial are rising even faster than inflation, many other property sectors and lease types are unable to raise rents fast enough to keep up with inflation. Many lease terms last 5 to 10 years or longer and have contractually fixed rate rents. Even most of these leases with inflation-based rents are capped at about 3 to 4%. So in other words, even though the rents are going up, a lot of these leases aren't going up because they've already got the contracts, and the contract state it can only go up so much per year. For these properties, 5% plus inflation slowly eats away at the real value of the REIT's income stream. This recent surge in inflation should not be too surprising, given that the government has increased the supply of money circulating in the economy by about 35% since the beginning of the pandemic. So just once again, you guys, all the money that flooded in is floating around, but it's not helping us. All right. This avalanche of dollars entering the economy had the effect of increasing consumers' capacity to spend, even as production halted and supply lines broke down. This is highly unusual for such a recessionary period, in which consumption capacity typically falls alongside the production, and it is why the official recession, defined by a drop in the GDP, only lasted about 2 months. But in normal economic times, the productive capacity of the American economy, not to mention the economies of the international trading partners, is so efficient and powerful as to be capable of ramping up output to meet growing demand, thereby preventing spikes in consumer prices. But, as we know, the more acute reason we've experienced this, such a surge, has been the supply chain breakdown. We all know by now about the terrible congestion of container ships at U.S. ports, which spurred the Biden administration to recently order West Coast ports to stay open, operating 24/7. Hopefully this should ease some of the pressure we see. And you can see here, this is the Port of Los Angeles, and all these green dots here are container ships. But even once the goods finally make it to shore, the supply chain dysfunction doesn't stop there. A shortage of truck drivers and other freight transportation services has limited the ability for goods sitting at ports to make it to their destination. Freight transportation output, which includes trucking, railways, and inland waterways, as well as air transport, is around the same level or below where it was immediately before the pandemic. Rough translation, you guys. We don't have enough truck drivers. We don't have enough rail cars once it gets unloaded to actually get it to where we need. This mismatch between consumer demand and broken or lagging supply chains is the primary driver of inflation right now, and it's why we believe that elevated CPI rates will prove transitory. So they're hoping that they're going to get this under control. And the bottom line is, if we go into an environment of rising interest rates and slowing economic growth, as it seems we might, many REITs would suffer and likely produce historically low returns in the coming years. However, you should note that the REIT sector is vast and versatile. And while some should be avoided, others remain very opportunistic. Being selective is more important than ever. So, what do you guys think? With this economy, do you think that REITs are going to suffer? Are they going to fall? Are they going to falter? I don't know the answer. I like having about 5% of my total portfolio in REITs, but I also know that there's risk involved. What do you guys do? Do you guys have REITs in your portfolio? Do you use actual real estate properties in your real portfolio? Let me know in the comments. Let me know if you think that this change with the inflation is going to make REITs go down or if they're going to be okay. If you think so, let me know. All right, you guys. I hope you got something out of this. If you did, do me a favor. Drop me the like. It really helps the algorithm. I was gone for a little while, but I'm back and I'm trying to catch up. I hope you guys will stick around. If you're not already subscribed, do me the favor. Hit that red button, ring the bell. All right, we'll see you. Thanks.